Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, smartest guy in the room, the man himself, the mayor of Beckerville, or the governor of Texas, Mr. Michael Becker.
Hey, Paul.
How are you, Mr.
Doing
Michael?
Doing well.
So how's everything going with SPI these
It's
days?
going pretty good. We're trying to hustle up some business. It's a little tough right now, but I'm sure we'll push through and get a couple things working, hopefully in the first quarter.
That's great. Michael, as you know, is the former banker from a large national bank. He's left the bank from being a loaner of money, and now he is an owner of real estate, and he does a great job with his group over at SPI.
What's going on in the Old Capital world, Paul?
So February the 6th, make sure you get an RSVP in to the Grapevine Convention Center here in Dallas. We have one of the economists for Freddie Mac is coming in from Washington, D.C. Kind of give us an overview of what's going on, what we can expect for 2019. I think his insight is going to be great. I think you really will enjoy him. I've listened to him. I've spent some time talking with him. He is a real sharp guy, and you want to spend some time watching his presentation. Also, David Kahn from CoStar will be in. David, if you've ever heard him before, he'll give great insight about where rents are in the Dallas, Fort Worth, Austin, San Antonio, and Houston markets. He really is an expert of Texas, on multifamily. And if you are coming in from another part of the world, want to make sure you spend some time with him too, because he can give you some insights about what's going on throughout the United States. So that is February 6th. Go into the Old Capital Podcast website, register for that. We'd love to see you. I think we already have 200 people going right now to that conference. We'll probably have 350 to 400 folks. So get your RSVP in there. Second thing, we're sponsoring a City House. City House is the hoop for the homeless. City House is a charity that really takes care of the kids between the years of 0 to about 17. It's kind of the safety net for kids that come from abusive parents or are just kind of abandoned. And City House kind of takes them over and gets them placed. We're supporting that on our 3-on-3 basketball tournament. 3-on-3 basketball tournament, March the 30th here in the Dallas-Fort Worth area at SMU, Southern Methodist University Fieldhouse. We're going to have a 3-on-3 tournament. And it's going to be between appraisers. It's going to be through investors. It's going to be the brokers in Dallas-Fort Worth. And that is going to be a lot of fun. So, building relationships on a social basis, you want to participate on that. We want you to play 3-on-3, form your own 3-on-3 tournament if you're an investor. We want to have you out there. So go to the Old Capital Podcast, register for the March 30th event at SMU called Hoops for Homelessness. We want you there. Come join us on that. So that's what's going on, Michael.
Sounds like a lot. So what do we have on the podcast today?
So on the podcast today, we have a friend of ours that we've known for a long period of time that helps us out and helps a lot of you folks out who are buying real estate. So when you buy some real estate, you typically are going to have it financed through the bank. So a bank is going to ask for a number of things. We call them third parties. One is the appraisal, one is a property condition assessment report, and the third one is a phase one. So those are the third-party reports that kind of give the bank a better idea about the collateral, what the valuation of the property. The appraiser is kind of the eyes and ears for the bank. It's a third-party independent company. They're not related to the lender. They shouldn't be related to the lender. They should not be related to you, certainly not related to us. But they're the eyes and ears for you to get a valuation of the property. So today, we have one of the best appraisers in Texas, actually one of the best appraisers in the nation. He works for a company called BBG, and our friend Grant Williamson. Grant, thanks for being the podcast. We appreciate that.
Yeah, thanks for having me.
So I'm going to turn it over to Michael. And Michael, let's start talking a little bit about appraising on multifamily properties and what people should know.
Hey, Grant, maybe start out giving a little background on yourself. Maybe talk a little bit about BBG and kind of what you guys do and maybe kind of the volume you guys did last couple of years.
Yeah, thanks for having me. So BBG is really kind of went through some exponential growth in the last few years. I'd say in the last 5 years, we've added 16 offices. So we're now at 31 offices, 500 employees.
31 offices throughout the United States.
Right, 31 offices throughout the nation. So we have it, national footprint now, whereas 6 or 7 years ago is primarily Texas. So yeah, it's a great company. This is my second company I've worked with, and I love it. I specifically run a team here in Dallas, appraising primarily multifamily. Although we specialize in Texas, we do appraise nationally, and we're more of a client-driven appraisal company. So if I've got a client that has a deal in Timbuktu, and they want some hand-holding on the Timbuktu appraisal, I'll go to Timbuktu.
So let me just ask you a quick question. Tell us a little bit about your background. You said this is the second company you've worked for in appraising, so you are an appraiser. What's your college background? How do you become an appraiser?
Sure, yeah. So I went to Baylor and graduated, and not a great time. The 2009, 2010 crash was right in my face, and was like, well, what can I do that's still actually doing any kind of business? And that was appraisal. So I started out at a larger firm, and there's one main path to becoming an appraiser. So you have to get state certified, and it's quite rigorous. It's 300 hours of classroom work. It's 18 months of experience, which it used to be 36, but it's been reduced, and then a pretty hard state test. So that's just to get state certified. I was state certified in 2013, I believe. And then the next path is to get your MAI, which is basically the equivalent to CPA, CFA, and that's even harder. And I just got that about a year ago.
No kidding.
Yeah.
So about how many appraisals BBG do a year, or how many would you do a year?
My team did around 350 last year. And then as a firm, we did about 4,000 as far as multifamily goes, and then probably, I think around 10,000 total.
Oh, wow. It's all commercial real estate predominantly?
Mm-hmm. All commercial. We don't do any residential. So
who's your client? Like you say, you work for your client, go to Timbuktu. So who's your client?
Primarily, I focus on agency lenders, so Fannie, Freddie types, but definitely do my share of bank work too. So anyone basically who's lending on a multi-deal, that's my client.
That's your client. That's good. So it's very rare for you guys that you work for investor, owner of a deal. Most of the work's driven through the lenders.
Sure. Yeah. I mean, 99% of it. I mean, every once in a while we'll do something but that's kind of special case stuff.
So maybe talk a little bit about kind of like you guys' role and what you guys serve for the lender. What's important to especially the Fannie and Freddie lenders? Like they engage you because it's a regulatory thing and they have to have an appraisal to kind of confirm value. But maybe kind of talk through what's important to Fannie and Freddie when you're doing these appraisals. How do you go about the actual appraising? What kind of approach do you take, et cetera? So maybe kind of talk through your basic job responsibilities.
Sure. Yeah. I mean, I think first and foremost, it's a true third-party thing. So they want a set of eyes to say, what is the true market value of this property? Backing up into what market value is, for an appraiser, a market value assumes a sale. So regardless of, this investor is refining, purchasing, et cetera, our appraisal assumes a sale. And so that can that gets a little tricky sometimes because on the lending side, there have all sorts of different assumptions because it's a refi or a sale, et cetera. So, what the agency lenders are looking for are certain points of, is this a good market? Are they performing? Is rent growth trending upward, downward, that sort of stuff. But more than anything, they're just making sure that whatever they're lending on, that amount is true market value.
And they also, when doing Fannie and Freddie, they also use your income approach. So maybe talk about, let's start with like kind of what are the three approaches that you guys do when you do an appraisal?
Sure. Yeah, there's three approaches to value for appraisal. There's income, sales, and cost. Typically for a multi-deal, we're doing income and sales only, unless it's 10 years or less, and then we do a cost approach too. Because multifamily is such a widely traded asset, and there's so much data out there, the income approach typically is the best approach because it's there's market parameters for income and expenses. There's so much data out there that's typically the most relied on approach.
So when you guys are doing the income approach, how do you go about determining like the value and all the revenue and expense assumptions that you guys make? Maybe kind of talk through that. How do you get the data? What are you looking at when you're doing the income approach?
Yeah, so when we're engaged, we ask either the lender or the borrower for financial statements. Typically, we're looking at the last 2 full years plus T3. which is trailing 3 months annualized to a full year. And so for income, typically we're relying more heavily on the last 3 months, and then, taking into consideration the last 12. And then on expenses, it's typically the last full 12 months is what we're kind of more relying on more.
And then when do you guys make adjustments to that? Or what would constitute you guys make an adjustment to either the income or the expense assumptions in your income approach?
Sure. So as far as an example goes, let's say, we're appraising a property and it's under contract. So former owner had payroll at $2,000 a unit, something like that. And that's not market. So we have to use our brains basically and be like, all right, what is a typical buyer going to do in this situation? Are they going to use $2,000 a unit for payroll? And they won't, right? So
sure.
we have to be able to, pick and choose, like, all right, well, is this market? Is this not market? There's some proof in the pudding sometimes when it comes to a property, but more than anything, market parameters kind of decide even expenses. So
how do you guys go about determining kind of the cap rate to value the NOI at? What's kind of behind that?
Cap rates are a little tricky to explain to people on our end because people throw around cap rates, but you got to ask what's that based on, right? So is that based on T12, T3 NOI, pro forma NOI? I mean, so you kind of have to understand what that's coming from, and especially now with taxes, are you adjusting taxes? But anyways, we try to do an apples to apples comparison. So if we're doing an appraisal, we're trying to get cap rate data from an apples to apples basis, which we consider pro forma. So 12 months going forward, what's the cap rate that they're actually buying it on?
And then where do you source the cap rate data from?
Typically other sales. Doing so many appraisals, doing over 300 appraisals, we're going to have a lot of purchases and a lot of data in our database.
Yeah.
We see a lot of deals. So typically most of our data comes from that.
Let me get back to expenses a little bit too, because if you're a brand new investor, you're kind of relying upon the financial statements from the previous owner or the owner of the property, and those may be all screwed up. It may come to them in a shoebox. A lot of things are added on there. A lot of things that should be taken off. And you said you kind of have to use your brain to kind of figure that out. Do you have any kind of rules of thumb on some of these properties for expenses, whether it is a two-pipe chiller, properties built in the 1970s, flat roofs? Any idea on a per unit basis what people should be looking for? Let's say you can market to market, but just say in the Dallas-Fort Worth market.
Yeah, for sure. I mean, I think there's definitely floors on what you can get away with as far as different expenses, payroll, R&M, that sort of thing. But when I'm looking at financials, let's say they're bad, like you're saying, back of the napkin type stuff, you kind of have to pick and choose which ones you can rely on and which ones you can't. I always say utilities are kind of proof in the pudding. They are what they are.
Right.
They have utility bills. Unless they're just leaking water all over the place, you're going to underwrite to exactly what they're paying for utilities. And then after that, I'm going to use market. I'm not going to, if they're, they've got CapEx in there or, stuff that's not operating costs, I'm almost just going to ignore it if it's that bad.
Right.
So,
because you have a lot of people that run these properties pretty thick on expenses. They run their car through it. If it's kind of a mom and pop, they run their medical bills through it. They run their vacation through it.
Right.
They run so many expenses out there. And so instead of having, it should be maybe $4,500 a door annual in expenses, it may be $57 or maybe $58, maybe $6,000 a door in expenses. So you kind of have to weed some of these numbers out of their operating statements.
Right. Yeah. And I mean, the good thing is most 99% of the borrowers I'm dealing with are educated. And so they already have a really good idea of, hey, this number is way too high. Here's where we're going to be. Don't you agree? And typically I agree because, it's just not market.
When somebody is looking to get a loan, they typically are going to give you some financial statements, the current operating statement of the property. And then you're going to ask for the pro forma on the deal. So tell us a little bit about how much faith you put into the borrower's pro forma.
It's definitely considered. I love to have it. I mean, we don't always get it, but I love to have it because at the end of the day, our definition of market value is a prudent buyer. And the best data we can have is buyers in the market and how they're looking at deals. And so the more data we get on that, the better. There's numbers that sometimes I'm like, I don't think you can achieve that.
Right.
But
it's just too skinny.
Right. It's too skinny. And, even if you can achieve it, my goal is to emulate a prudent, normal buyer. So let's say, well, I'm going to be on site, so I don't need payroll. Well, a normal buyer's not going to do that.
Right. If the property gets back to the lender because it's foreclosed upon, how does the lender going to be able to manage the property? That's the way that we have to look at it.
Right, exactly. So, there are certain efficiencies that, owners have that's great. I mean, they get that's cash in their pocket, but I can't necessarily underwrite that.
Right. So that's an important thing to know is that if you're kind of a new buyer and you're thinking that I'm just going to run the property, I'm going to self-manage, and that's not going to count as an expense, we've got to count it as an expense. If you're maintaining the property and you're going to be the maintenance person, I've got to count that as an expense. Anything more to add to that?
Yeah, no. When you look at the kind of like the value add approach, is there any sort of different way you look at a value, or you value deals, whether the property is kind of tired and dated, and the new ownership group's going to do a big heavy lift, or is everything kind of the same? Whether it's like a stabilized deal that's just kind of plug and play and cash flow, do you look at those deals differently in a value add scenario versus kind of a stabilized deal?
Yeah, for sure. I mean, I think there's two general types of value add. There's a light value add, and I kind of value those a little bit differently, where it's almost just a straight line deduction. So let's say stabilized value is, let's call it $10 million for the sake of numbers, and then they're going to put in $500,000. And some of that is, exterior, some of it's interior, but it's a pretty light value add, right? So that's more of like a straight line deduction. But I mean, there's also value add deals where, it's a heavy value add. They're doing all the unit interiors. It's a 3-year process. I'm going to look at that a little differently. I'm going to look at it over 3 years and kind of back down to what it is as is.
And then you'll give an as is, as stabilized value on a value add appraisal versus like a just kind of a normal refinance, or kind of just more of a brand new turnkey deal. You just only give as is values. Is that typical?
Yeah, I mean, we're almost always giving an as is value, and then depending on what the lender is asking for in our scope, we can give a stabilized value too, but always as is.
So one of the biggest challenges for the last many years, in particular in Texas, is kind of property taxes. Maybe talk a little bit more. How do you guys kind of value the property taxes, or how do you look at that? I mean, what kind of pro forma adjustments do you typically make? I know it's kind of property by property and county by county, but what's some kind of general thoughts or rules of thumb around that?
Yeah, I mean, I think what you said is kind of hitting the nail on the head, is that it is property by property. I mean, anyone who kind of flat blanket says, all right, it needs to be X percent of value anywhere in the state, any vintage property, is doing themselves a disservice. So we look at 3 things primarily. We look at tax comparables, which basically we get the most comparable rental properties around there and say, all right, they're at 40 a door and we're at 40 a door. That makes sense. We also look at percentage to value, so assessed value to value, and we kind of use market norms. And then finally, we look at where they're at now. So let's say a typical submarket, this is, most people would say 60% of value is kind of the market norm. And then you pull this property up and they're currently at 20%. Well, to get to 60%, are you really going to triple the taxes? No. Yeah. It's just not feasible. That's not what the county's going to do. So you really need to look at where you're starting at too. So
yeah, that's good. Is there any things that you're seeing you look at a lot of deals, like you said, you guys did about 300 deals on your team alone last year. Is there anything you're seeing out in the marketplace that's like a value add renovation that is very impactful, that you kind of think that more owners should be potentially trying to implement on their properties?
I think the typical value add of your appliances, flooring has been done and it's worked. I mean, I think there's a pretty good concept out there of what works and what doesn't. And I think most people realize that by now. I mean, I think over the last 4 or 5 years, we can all agree everyone's kind of doing the same value add by now, which is a good thing. We kind of know what tenants want. But there are some smaller things that owners are starting to do to kind of get a little bit more off the top. Some things I'm seeing that are attracting tenants, the Amazon lockers. Mm-hmm. I mean, it's kind of crazy when you think about 2 years ago, we would have never understood what that meant. But what's an Amazon locker? But now we all know exactly because we order our entire life off there.
Yeah.
So having a designated area for that on a property is huge. I mean, it helps out management. They're not dealing with everyone's packages all day. They're able to actually work. And then tenants are able to actually go, all right, this is my locker. Here's my package. So yeah.
I want to get back to expenses because that's such a big role in getting these loans approved. And one of the things is that, the state of Texas is a non-disclosure state, which means that if you're buying a property, the state doesn't really know what you bought that property for. But how can people help? Because, the property taxes is such a large line item. Let's use your $10 million example. Are you guys using 100% to figure out the property taxes? Are you using 85%? Are you using 75% of the sales price of the property? Going back to that. And then we're kind of on the lending side, we're kind of hamstrung by debt coverage ratio. So we got to get that property tax right at the beginning, and we really only listen to when we underwrite these deals only Grant's number. So Grant's number, you can give me as a borrower what you think property taxes are, but it's really Grant that's going to be the one who puts that number together, and that's what the lender in Fannie Mae only uses, Grant's number. So is it better for when somebody comes in, when they have a pro forma that shows what the property taxes are, do they have something that in writing that backs up what they think the property taxes are that can help you, like go to a tax company that can show you in writing what they think the property taxes are going to be? Does that help you?
A little bit, not a ton, just because, again, my goal in market value is what is a typical buyer going to do. And, trying to estimate what these counties are going to do year to year is nearly impossible. And so my goal is not to guess what the assessed value is going to be next year. My goal is to emulate what buyers are doing. So these property tax consultants are kind of doing the opposite. They're trying to guess what the county's going to do, right? So, because that's their job and that's what they're getting paid to do. And that helps. It's not bad data because, it's kind of a circular, pattern, because what buyers are doing is kind of what the tax consultants are telling them. So that's also kind of market too. So it definitely helps, but it's not.
So property tax consultants can help you, but it's not the end all be all. That's what you're telling me.
Right.
All right. Take me out to a couple other states. How do they calculate future property taxes on a sale?
Yeah, so Texas is easily the most difficult of all the states I've worked in. Oklahoma is a disclosure state. So when you sell a property for $3 million, your assessment value is probably going to go up to $3 million. Typically it's 95%, but it's right near that. And so if that happened in Texas, that wouldn't be good, right? I mean, we would all be upset if that happened, but because they've done that for so long and there's no secrets on it, it kind of is easier to underwrite a deal.
Any other states that you can kind of give us behind the curtain of how they calculate property taxes?
Well, I would say most other states have some sort of cap on increases.
Okay.
And Greg Abbott's actually got a plan to change that in Texas. So
Greg Abbott, who's the governor, the real governor of Texas.
I'm offended.
Yeah.
Michael owns so much real estate in Texas and pays so much in property taxes. The state of Texas should be hiring a limousine to pick you up every day.
Oh my God! I don't know how much you even paid taxes. $3-4 million at least. Well, more than that. No, I don't know. Maybe $10 million. That's a ton of property taxes.
You guys pay a lot of taxes, I'm going to believe.
Yeah. So he's got a plan to limit total property taxes increases to 2.5% a year, which means it's not your value. It's not your assessed value that can't increase that much. It's your actual property taxes. So what would that look like? Well, what that would look like is all the county, the school, the city, all the people collecting taxes, they would have to lower their tax rate rather than because the tax basis is going to keep on increasing in a good market, correct? So if they can only increase 2.5% a year, they're just going to continue to lower the tax rate, which would be huge for everyone. It would be it'd be a huge windfall for the state.
Is that going to be on both commercial and residential?
Yeah. So, on the residential side, what is that going to save an average person? $100 to $200, not a huge deal, right? But on the commercial side, it could be
hundreds of thousands.
Yeah.
So you talked a little bit about amenities with the Amazon package lockers. Mike is a big believer in that. That certainly helped you and your group out. You've walked so many units and so many properties. What are you seeing for amenities on these B and C properties these days?
I think it's funny because amenities are more about selling to that prospective tenant in the first time they're there than they're actually used. So you show them, look at this awesome workout facility, look at all this, and then they never use it, which it doesn't really matter if they use it, right? You got them in the door and they liked that amenity, and that's why they decided. Right. So I think as far as community amenities go, I always say the cheapest, most attractive one on the first day is the best one, right? Mm-hmm. Because you're not spending a ton on actually getting it in there, but you're also getting a tenant to go, wow, I want to live here.
What is that, Michael? What do you get is the hook to bring people in?
I think you have to have a nice clubhouse. I think you have to have a nice fitness center, a nice pool. I always think of like the walking tour. When I'm doing it, you put your model unit on the backside and you walk them through all your nice amenities. And like Grant's right, like no one uses this crap. Like no one works out, no one goes to the pool. I mean, very few people do, but
right.
Like you said, it doesn't matter as long as when you're selling it. And then the other part of it too is like when you got a broker listing your property for sale at the end of start and end of every tour is in that clubhouse. You have a nice clubhouse. That's kind of the first and last impression that a prospective buyer, either a tenant or a prospective buyer are gonna do. So all the selling, you need to have a nice environment when people are making a decision to sign that lease or buy your property. I think that just makes sense.
So we walked through a lot of 70s and 80s apartment units. What are you seeing in that range of amenities right there? I mean, these properties that were built 30, 40, 50 years ago, can you get them to the next level in some of these areas?
Yeah, you really can. I mean, I've seen some pretty amazing renovations on even like 60s properties where, the office was in a unit. And they're just like, all right, we got to have this amenity package if we want to compete. And so I've seen people build from ground up a leasing office clubhouse. And I've also seen, let's take 2 units down or 3 units down and make a clubhouse. It's that important. So I've seen people do it. I mean, I think like Michael said, it's very important for the tenant when they first get there to feel, all right, I like this place.
Maybe we kind of pivot a little bit. You said your team did about 300 multifamily appraisals last year and company about 4,000, and you do it all over the nation. So maybe you kind of give Grant's opinion of kind of the state of the market as we're the first couple of weeks of 2019. What kind of how did 2018 go kind of compared to what you thought, and kind of just your general thoughts on the overall multifamily marketplace in general nationwide?
I'd say that my outlook is the same as it's been for the last 3 or 4 years. It's cautiously optimistic, and the reason I say that is because there's been a lot of macro noise. I mean, we've got between Trump's tax plan and Trump's trade war and 10 years kind of going all over the place. There's been a lot of outside activity, but at the same time, I mean, deals keep happening. I mean, it's almost like an unstoppable train right now, which is a good thing. I mean, it's a sign of a good market, in my opinion. So I think 2019 will be, very similar to 2018.
Just going back to, 300-400 appraisals that your group has done, let's say out of 10 appraisals that you guys get assignments for, how many are value added? How many are stabilized that won't need a work to be done on the property? I'm trying to get an idea of what people are buying out there through your eyes.
Right. I mean, I'd say these days 75% of them have some sort of value add component. Whether we're considering it or the lenders considering it is another question. But typically the buyer of a stabilized asset that's not going to do any type of value add is an institutional buyer, right? Mm-hmm. So, and there's just less trades of those. It's just the nature of it. And so, but even those, they're going to try and find something to value add, right? I mean, even you're starting to see, uptown properties in Dallas start to get renovated, the ones that were built in 2000 and don't have all the new amenities. So you still see some even like that.
What's kind of like your opinion, some of the top and bottom kind of 2-3 markets that you kind of see fundamentals across the nation? What are your kind of favorites and least favorite markets right now?
I think Dallas-Fort Worth is still one of the top ones. I mean, there's still good yield out there in Dallas-Fort Worth. I mean, it's definitely getting more competitive and tighter, but compared to some other markets, like I think Austin is still pretty tight. Houston's just hard to put your thumb on. I mean, with oil and the hurricane. I mean, it just kind of had so much volatility in the last 2 years, but it's still there. The fundamentals are good. So I kind of like as far as what looks more attractive. I'm not a huge investor, but I like the tertiary markets right now in Texas. Yeah. I think that's where the best yield is still.
Anyone in particular, or any couple in particular that you praise that you thought had pretty strong fundamentals?
Yeah, I mean, I think that the ideal size is kind of that Waco, Tyler type, middle market where they're on a major interstate, so they have potential to grow. you're still seeing some higher cap rates there.
So appraisers are like accountants, they're like analysts. I mean, they take a lot of the raw numbers and try to figure out to quantify their decisions. So if you had $1 million this day, Grant, where would you put your money in real estate?
Oh, man, that's a great question. It's really a deal-by-deal basis. I mean, there's some deals I appraise and I'm like, this is the value, but I wouldn't put my money into it, you know? And then there's other ones I'm like, man, if I had $1 million, I would invest in this all day long. But it's really a deal-by-deal basis. And sometimes it's, let's say a mom and pop's own it for 10, 15 years and they just haven't been pushing rents. And then it's in the middle of, a popular submarket like Arlington. That could be a really, good investment. But then there's other ones that are in Killeen and it's a 9 cap. And when's the last time anyone bought anything at a 9 cap? So that's also pretty attractive.
Any particular markets or sub-markets that you've seen kind of bad fundamentals in that you're a little bit more cautious about?
Yeah, I think San Antonio's kind of had a tough time with all the new supply, and so occupancies are a little strained there. Certain parts of Houston, North Houston's kind of had that same thing. But, I mean, even that, we're talking 9%. I mean, that's not that bad.
So, appraisers are independent beings that, they go off the raw facts of what's going on and they give you their value of in the opinion of a arm's length transaction between a buyer and a seller. So advice to folks that maybe are looking to do their first transaction that have never talked or spent any time with a commercial appraiser, because it's, again, completely different from residential 1 to 4s versus having a commercial appraiser like you and your company. What would you say to them for advice on how to treat appraisers and what helps them get to what they want to get?
Yeah, sure. I mean, look at us like an integral part of the process, whether you believe it or not.
Yeah.
Look at it that way. If you're doing a value add, know what your value add is very specifically, because we have to know.
Yeah.
So if you're kind of waffling on what you want to do, that makes our job incredibly difficult, and the process is going to be incredibly difficult for you.
Should they have that information up front, or they just tell you, I'm going to spend $50,000 in blah, 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 but I'll tell you that in 2-3 weeks after I have a bunch of the bids to be done, and I don't know where I'm going to really put that money into. So it's better to kind of tell you up front.
Yeah, I mean, you tell me up front, because, and you say I'm going to spend $500,000, that's not enough for me. I need to know exactly what you're spending it on, the timeline, where you think rents are going to go because you're doing X interior renovation, how long it's going to take.
Do they have to support that information about where they think rents are going to go to? So another property that they see that they want to emulate or get to, down the street that has already been doing that, should you as a new borrower share that information with you, the appraiser?
Yeah, 100%. I mean,
sense.
I'm going to do that anyways, right?
Yeah.
I'm going to say, all right, well, here's where your pro forma rents are, and here's a property next door that's got a similar renovation. So I'm going to check it. But if you know of this property already, tell me. I mean, that you've already done more due diligence on this property than I'll ever do.
So talk a little bit about some of the forms that you need to have up front when you get the assignment. So because a lot of people think it's just the operating statement, it's maybe the offering memorandum on the deal, the rent roll, and that's it. But you're going to come back and ask for some additional information to the lender or which is eventually going to be you, the borrower. Tell everybody about what else you're going to be looking for.
Right. I mean, I think any appraiser has, their own types of forms that they have. But in general, the reason we're asking for that is that we can't rely on an OM for the basic information, how many parking spaces, that sort of thing. And the reason being is that an OM is produced by an investment sales team that has a very specific goal, and that is to sell the property. And their due diligence could be great, but it could not be. And they're just trying to get something on paper, whereas my lender wants to know the exact answer. And so it just makes the process a lot easier if you just say, what can we do? What can we do to get this done? Because it's easy. I mean, it's easy stuff. It's stuff you know. And the longer you kind of dig in your heels and kind of, make the process go, it's just going to make it harder on yourself.
Talking about digging in the heels, what's the 1 or 2 or 3 different ways you can piss off an appraiser? Because the appraiser is such an important part of your team. You don't want to piss off the appraiser. You want to have them help you, help me help you type of stuff.
Yeah, I mean, I think the best borrowers are ones that understand we're all kind of on the same team, right? We're all trying to get this deal done and, in the right way and above board. So anytime you kind of look at us as part of the process that doesn't matter, it's not that it's going to make me mad. It's going to hurt you. Because the first thing I'll do is I'll call my lender and say, hey, we're on hold because the borrower won't give me what I need.
Yeah, because I want to kind of talk about that, and Mike knows this very well, is that the assignment that, say, Grant and BBG get, it's not from you as the borrower. It's from the lender. And so their relationship and their contract is with the lender, and it's not with you. So if you get on the phone and try to yell at Grant because Grant didn't see something or didn't believe what you were saying, again, Grant's looked at, say, 300-400 appraisals this year and 300 or 400 or 500 appraisals last year and blah, blah, blah. But you've only done one or two of these transactions. Let's say one, he doesn't want to talk with you. He's going to talk with the lender. And then it's up to the lender to make a decision if they wanted to either do a conference call or not have you even get involved.
Right. I would say if you ever have an issue with an appraiser, the first person you need to reach out to is your lender, not the appraiser.
That's it.
Because the relationship with the appraiser is to the lender. And so typically they know each other very, very well. And there's an easier way to do that. Rather than getting on the phone and screaming at an appraiser, get on the phone and tell the lender to scream at the appraiser. You know what I'm saying? So they'd be more willing to hear the lender out than you.
Yeah, you're not going to win any fans by screaming at an appraiser and take an adversarial role with the appraiser. That just doesn't work. I've closed 5,700 transactions, and I think we all try to play good in the sandbox. And by pissing off an appraiser, you're not helping yourself. And also, too, is that everyone thinks they can get a copy of the appraisal right at the beginning. That's not the way it works, is it, Grant?
No. So, I was going to say that the hardest explanation to a borrower is, hey, you can't have this appraisal just because, you technically did pay for it and this is your property, but legally, I am bound to this appraisal to the lender. They ordered the appraisal. And so call your lender, say, can you release this appraisal? And I'm happy to. I can do it in 10 minutes. But I can't do it without the lender's approval.
That's right. Anything more, Michael, to add to it?
No, I think that's it's all been good advice. And I think it's exactly right that the appraisers are an integral part of this whole thing. They're kind of the check for the lender, requirement. It's like anything with the lender. They typically don't ask for stuff they don't need. Same thing with the appraiser. He's not going to ask you for stuff just because he wants to see it. It's for a specific purpose to help him or her do their job and deliver an appraisal on time to the lender so everyone kind of close on time and kind of check the regulatory box they need to check and feel good about the deal. And I think that's that's real important that when you guys have specific market data, something on a comp, something on, why you feel you can get this payroll number, or here's my insurance quote, or something kind of relevant to it. I think the more you share that with the appraiser and your lender, I think the better off the results ultimately are going to be. Because the lenders certainly, when they're doing their underwriting, they're going to kind of cross-check and match up their assumptions on payroll and taxes and stuff with the income approach that Grant's going to put together in their appraisals. So kind of hand in glove with what how the lender underwrites is really the document that Grant produces. So having him have all the information, good information, that'll just do nothing but kind of help you out along the way. Yeah,
like a lot of people don't understand a commercial appraiser like you. There's only a handful in the state of Texas or throughout the United States. I mean, and especially with the designation that you have, how many Masters in Appraisal Institute appraisers are there, let's say, in Texas?
Oh, that's a good question. I would guess like 1,000.
Yeah, it's not very much.
No.
I mean, on the residential side, there's on the 1 to 4 units, probably none. On the 1 to 4s, they may have. I mean, they may have a few, but it's really for a commercial appraiser gets that designation. It's like a master's degree in appraisal. So it's a great designation. Also, too, like my point is, there's not a lot of commercial appraisers out there. So if you piss one off, that's a small community that people will kind of figure that you could be a difficult person to work with and that won't want to work with you. And so I would say on the residential side, 1 to 4s, $325, $400, or $500 these days to get a single family appraisal done. And let's say there's 10,000 appraisers in the state of Texas. Mm-hmm. I don't know, but it's going to cost them $3,500 to $6,000 to do a commercial appraisal. And then usually it's 2 to 3 weeks, and if you get 3 to 4 weeks, if you wanted it to be done a little bit faster, you can expedite it for another $1,500 or $2,000. Is that right?
Yeah. I mean, that's pretty close to the pricing, and Yeah, I think depends on the company too. So my team does so many multifamily, and we specialize in that. We can be faster, and that's kind of one of our sells. If you need it in a week, it'll cost you, but we can do it pretty much any time of year and any kind of property. So if you're trying to close quick, that's one of our biggest sells.
So you can't talk to Grant, but you could request Grant's company if you're looking to possibly to do a loan in the future. Just ask for BBG to do your transaction if that makes sense to the lender and to you. So I think that's a good way. Michael, let's finish it up here. Anything else?
Yeah, no, I appreciate you coming to the podcast and sharing a little bit of knowledge about appraisals. I think it's valuable information, and people don't really think too much about that when they're doing a transaction. But really, a lot of the expense assumptions that the lender uses really have to jive with what Grant puts together in his appraisal. So it's a very integral part of this whole thing, and I don't think people really fully appreciate that how much weight the lender really puts on the income approach that Grant puts together in his appraisal.
Yeah, it really should be the eyes and ears of you two, and it's not only the eyes and ears of the lender, but there's another line of due diligence to make sure that you're buying this property right. I mean, everybody, the offering memorandum from the broker is going to say it's going to be slanted. I mean, that's what they're trying to sell this property, and you maybe have bought into it. I get that, but you need to have a third party, an independent person, kind of cut through the bullshit to kind of figure out, is that right?
Right.
Are those assumptions correct?
Right.
Can I operate this property this way? And I mean, if you've only done 1 or 2 or 3 transactions or 5 transactions, you may not understand the whole deal. But if you've done 400 or 500 transactions like Grant and his team do, they can kind of tell you on these successful transactions how they're put together and what the expenses should be used on these properties.
Sure. Yeah, I think that's a very accurate description of what we can do for you. Is trust the fact that we see enough deals that if there's a red flag, we have a good reason for telling you that.
That's great. So thanks for being in the podcast, Grant Williamson with BBG. We appreciate that. If you think the content of the information that we put out there on the podcast is good, go into iTunes and give us a 5-star rating. We would appreciate that. And then if you go to the Old Capital Podcast and you want to understand the 15-page white paper report on the fundamentals of multifamily financing, Michael Becker and I and James Eng wrote that. I think that would help you kind of understand a little bit about the basics of underwriting apartment loans. So for Grant Williamson, for Michael Becker, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.